Yo, guys! Welcome back to the Liquidity Lounge, your go-to podcast for navigating the ever-evolving and thrilling realm of Web3 investing. And today we're embarking on a journey through the captivating landscape of Web3 startups, specifically focusing on the distinct differences between early stage and late stage ventures. Get ready to deep dive as we dissect the unique characteristics that define each stage. We will explore the exciting potential and inherent challenges of investing in a nascent project still finding their footing while also examining the established players already making waves in the Web3 space. And of course, I'm not here alone. Here with me, a friend from BlockLogica, acceleration cohort, Aza. Welcome. How are you doing?
Hey, Polly, how are
I'm
you?
fine.
Happy to be here.
I'm fine. I'm very intrigued about this episode. I'm very engaged in it. I have the energy to discuss all the potential questions. And guys, if you have any questions, feel free to shield them in the comments. We will be ready to answer and some of them if we will have some free time. So yeah. Hazel, can you please just give a brief intro about yourself and about BlockLogica for the listeners so they can understand why we're discussing this topic today?
Yes, sure, why not? First of all, I'm Asal, co-founder of BlockLogica. I come from, just to give you a quick background about myself, I come from background. I've been active in the crypto and Web3 space since 2017. I entered from basically investment sector. I was mainly helping different investors with different sorts of fundamental analysis on different projects. Have been active in the due diligence sector of different VCs and investment companies. So mainly for the first 3 years of my activities in the Web3 space, I was focused in helping the investors to find the right investments. And after that, I got more involved in incubators, accelerators, and also empowering different projects for fitting themselves in the market, entering the kind of marketing their products. So different volatile market where sustaining is the big projects. So after that, I got involved in the project, felt the pains that they have, felt the gaps that are there in the market, especially when it comes to fundraising. Mia projects, have these great ideas and really great skills in terms of development, but never find a way to fit themselves in the market to raise funds. And we came up with this idea of building BlockLogica to be an ultimate way for these projects that have the potential, have the right team, and have the right expertise to use the experience of people who have built the first generation of market leaders in the Web3 market and be able to have a higher win rate in the market, higher chance to form the next generation of market leaders. So we created BlockLogica with a team of Web3 natives, people who have proven track record in the Web3 space, known working in the known companies of this space, including Near, Polygon, Maker, Alway, Balancer, Bankless. So you can easily check our website and see the background of the team. But anyway, we are now offering 3 lines of main services in BlockLogica Labs. The first one is Grow Lab, which is our incubation program. This is a unique hands-on boutique incubation program that we are offering to
Hazel, sorry,
project.
I think that I can hear you. Guys, can you tell me if you can hear Hazel? Just tap in the comments, please. Hazel, can you say something?
Yes, can you hear me?
Yeah, but I think it's with the glitches, with the big
Oh,
glitches.
okay. Um,
Do you have a stable
is it better?
connection?
Technically, I should have, but let me try to. Is
Please
it
double
better now?
check. Yeah, right now it's right now I can hear you well. Awesome. And I just wanted to give you a compliment about how rapidly you are growing, guys, because partners like Doxan, Notion, Hacking, and advisors background like Stake Capital, Audicity, what Polygon Labs. This is very promising, and I'm very inspired about your work. So yeah, I think that
Thank you.
this conversation gonna be really insightful for our listeners today, and I want to start right away because today we will be dissecting the intricacies of investment strategies, uncovering promising trends maybe, and examining the exit strategies maybe as well available to investors at both stages. Grab your favorite beverage, guys, and get ready to dive into the Liquidity Lounge, where we explore the future of finance in the decentralized and centralized and hybrid world. So, on the agenda right now, I have one question for you, Azel. What are the key differences between early stage and late stage startups in the Web3 space? Just to explain for our listeners in a simple way.
Yeah, sure. Okay, just to quickly go back to where I dropped. I told you about the incubation program, which is Grow Lab, and we have another type of the services we're providing, which is Fund Lab, which is mainly focused on the subject of this space, which is fundraising, and we help the projects to find the right investors and and help the investors to find the right investments, basically. And this here comes the main challenge that we're facing. Early stage projects vs later stage. Obviously, early stage projects are projects that are usually pre TGE, They still don't have their tokens live. Even they even most of the times don't have their MVP. So anything between the POC stage to pre-MVP, we call it the early stage most of the times. And the projects in this stage need a big support, and they need motivation more than anything, because sustaining and surviving in different phases of the market when you are an early stage is really difficult sometimes, and it's really dependent on the team of the project and many different factors that we will discuss. But later stage projects are obviously the projects that most of the times are post TG. They are active in the market, they have an active user base, they have an active product. Sometimes they are, they're not still in the last version of their product, but anyway, they have a working product, even in beta mode, or different stages. But anyway, the user base is there. So in these stages, obviously the investment is more safe and secure for the investor, because they can see the product running, they can see the user base, and usually the valuation of the project is pretty higher than early stage, obviously.
Yeah, awesome. And sorry that I dropped you like that, because I think that I didn't hear where you end your speech, and I was like, oh yeah, it was about partners. I should continue about that. Sorry. We definitely gonna repeat everything one more time at the end of the episode, so listeners can be engaged more in your hard work. But as for the key differences between early stage and late stage projects, I also can say that they differ in several criterias. Uh, to simplify, it's product, tempo, focus, funding, and community. Um, Early stage project focus is building a product market fit, gathering user feedback, and iterating quickly. The funding, primarily seed rounds and angel investments, often focused on building a strong foundation, and community is growing, engaged, and often enthusiastic about the project's potential. But as for the late stage, the focus on expanding the user base and increasing revenue and building a sustainable business model, rather than just funding or building product market fit. And as for funding, Series A and beyond, often from venture capitals and institutional investors. And as for community, it should be well established with a strong engagement and often active participation in governance as well. So the journey from early stage to late stage is challenging, but it's a rewarding one for those who can navigate the complexities of the Web3 space. And the future of this industry is bright, and both early stage and late stage startups have a crucial role to play in shaping it. Azel, you can just cut me if I cut off if I'm not correct in my words regarding the criterias, because this is just my experience. I do not have that huge experience that you have regarding all the due diligence, so maybe I missed something as well.
That is so true in terms of the challenges they're facing. And as you mentioned, early stage projects really have big challenges in the fundamentals of the project, obviously. Working through the product market fit, having even sometimes having a really deep market research is really important for them, making sure that they are actually working on the right pain point, and they have competitive advantage comparing to the existing products. So really the challenges are different, and obviously the challenges are more fundamental for early stage projects, but the later the project is standing in terms of this stage, obviously the challenges change into having enough community members, having a wide user base, having the right partners, and expanding the business that is being built in order to sustain in the market.
True, 100%. And I want to discuss how does the involvement of venture capital differ in early stage versus late stage Web3 investments, because well, it's crucial role and approach and focus differ significantly. isn't it?
Yes, correct. It really depends on which type of VCs we're talking about. But anyway, as it's obvious, the early stage projects are riskier than later stage projects. Although, if you want to calculate the percentage of revenue, which I think we'll talk about it later, obviously early stage projects have a higher potential of having higher revenues as well. But the point is that they are riskier, and if you don't have enough monitoring and enough support for the project, there is a really high probability that the project in early challenges, there is no guarantee that they can overcome all of these challenges. So for the because of these type of investments, usually top tier VCs and tier 1 tier 2 VCs do not enter really early stage projects. Again, it depends on the project, the founders, the team. Sometimes they are really brilliant that anyone can enter even in the POC stage, but we're talking about the average projects. In average cases, usually the VCs, especially the VCs that have bigger ticket sizes, prefer to enter later stage projects because usually there is a lead investor or there are other investors involved in the project. You know that the project will not face financial problems, and some angles and some aspects of the projects have been proven over time. But smaller VCs and especially angel investors or smaller investment funds usually focus on early stage projects. First of all, because the ticket sizes are smaller, they can get a bigger, I can say, a bigger part of the project, whether it's token or it's equity. They can get a bigger part because the project has a lower valuation, and definitely it's a better match for them. So usually early stage projects start with being self-funded, and then having friends and family rounds, and just having some internal cash to go through the first stages. Then they will go for angel investors and individuals, and then after that the smaller VCs, and then they go for the bigger VCs. So obviously the bigger VCs are more interested in later stage projects because it's safer for them, and it has less risk to be involved in.
Got it. So, okay, imagine you're a seasoned investor looking at a bustling Web3 marketplace. Yeah, you see a mix of promising startups, some just getting off the ground, others already gaining momentum. How you approach each investment depends on their stage, early stage or late stage. And venture capitalists are the folks who fuel this growth. In early stage Web3, they're the early adopters of a new frontier. They're looking for disruptive ideas, innovative technologies, and passionate teams with the vision for the future. Of course, everyone has this gut feeling, but it's another core theme. So early stage investments are high risk, as you said, and I want to talk about risk a little bit more about in detail about later. So VCs are comfortable with uncertainty, knowing that most early stage ventures won't succeed. They invest smaller amounts in seed rounds, focusing on building a strong team and validating the product market fit. But when a Web3 startup starts showing real promise, it moves into the late stage, and now the VC shifts from explorers to builders. They are looking for companies with established products, strong user bases, and proven revenue models. Their focus is on scaling operations, expanding market share, and ensuring long-term sustainability. Late stage investments are about growth and expansion. VCs in this phase are less risk averse, preferring companies with a clear track record and a solid path to profitability. And they invest large amounts in later rounds, focusing on building out infrastructure, marketing, and sales. So, yeah, there is a big difference. But let's talk about some risks. What are the primary risks associated with investing in early stage Web3 startups? Let's break the ice here.
Yes, actually, there are many risks involved in early stage investments, not only in VC investments and let's say angel investments, but also in smaller investments, including grants. Currently in BlockLogica, we are working with different blockchains and different chains that provide different sorts of supports for their builders, including grants. And grants are usually much smaller in the ticket size comparing to those other types of investments that come in later stages, because their role is to motivate the builders to continue building on that chain. But if you talk with any of these chains, they all will confirm that a big part and a big percentage of builders that take the grant usually leave the chain and leave the project just a few months later. Some of them are called grant hunters because they are there to just take the grant. But we are not just talking about the abuses of these supports. We're talking even about legit projects and legit teams that are really there to build something, but they will be demotivated over time because of many reasons. The first reason is usually lacking the financial resources. So one of the biggest challenges is for them to have enough financial resources to continue building. But other than that, to have a successful project, a big set of lots of skills, from management skills to development skills, marketing skills, partnerships, BD, on the one hand, pitch deck, and being able to in the right way. On the other hand, build the right community. So, like, we can say a big set of maybe more than 20 skills are needed to have a successful project over time in the market. And obviously, not any person, I think no one can claim that he or she has the full set of all these skills, and even if they do, they have a limited bandwidth and they cannot focus on all the angles. So sustaining all these different angles is difficult, and many of the projects face these challenges. Even in crypto, we have challenges for the legal side, for the regulation side. Many of the projects cannot sustain and cannot get matched the uh, side of the market. So many of the challenges that projects are being demotivated, then they start thinking about, okay, maybe this project was wrong from the beginning, and many of the projects just leave it before they reach to the MVP. So there is this common number in the community that they say from maybe 8 or 9 of them even leave the project. They don't deliver, or they don't reach to the, you can call them an active product, and they wouldn't give the investor any types of profit. But maybe 1 or 2 are the ones that end up being successful projects. So these risks, I think, are from many angles, as I mentioned, from the legal side to the team management to the financial side. And when the project is early stage, obviously there are lots of new challenges that the project might face, and they don't have enough experience even to know how to deal with these challenges. Sometimes a technical challenge, for example, can be really huge when the project is early stage, while when the project is later stage, it can easily be solved by contacting one of the service providers that the founder knows within the network. Like, sometimes when you have the network and you have been in the market since long, you can easily solve these type of projects with different contacts that you have, the network that you have. But early stage teams sometimes even lack that access and that network. So all these risks are there, and even sometimes the investors invest in early stage projects that are supposed to have tokens, but the TGE never happens, the listing never happens, or the project never delivers. And that is why we are now, as BlockLogica or companies like us, we are trying to provide incubation, provide different sorts of support for the projects and for the investors, to make sure that after the investment is done, and the initial support is there, we are there to also help the project, not only with money, because the project only doesn't need money. The project needs help in legal, the project needs help in technical, marketing, GTM, listings, even entering the market, and many, many different angles. So we are there to help them this support, and also help the investor to make sure after they're investing in the project, somebody is there to monitor, somebody is there to help the project make sure that they will deliver, and the investors will not be alone there with the money and then deciding, okay, what should we do, how should we now um, spend these resources in the best way, how should we optimize our operations. So we are now trying to solve this problem, in fact, in the market, because early stage projects have these risks and they need external assistance to face them.
Whoa, this was very fulfilling speech, and yeah, you completely right. And I thought that you will forgot something about some risks, but no, you listed all. I wanted to talk about unproven technology, like Web3 is still evolving, and what's cutting edge today could be obsolete tomorrow, and you're essentially back in a technology that hasn't been thoroughly tested or widely adopted yet. And the crypto market itself is another major risk factor. Yes, notoriously volatile, and with prices fluctuate. Jesus, this is just the evening of the day, of the working day. Maybe my brain not working right now. Sorry. So yeah, I will drop it. Okay, risks are real, guys. This is what I wanted to say. And the potential rewards of investing in really stage Web3 startups are also considerable. If you're willing to take on the risk, you could be a part of transformative industry with enormous potential. Just remember, thorough due diligence and a deep understanding of the risks are essential before you invest. So yeah, and maybe we can talk about some metrics, like how does the potential for return on investment differ between early stage and late stage Web3 startups? Because I think that in early stage there is a high potential and big risks, and in late stage lower potential, lower risks.
Yes, exactly. There is a really huge difference between early stage and later stage projects in terms of the potential for growth, because obviously, when the project starts, they have a really, really low valuation. Even sometimes the project is not even ready to be evaluated, because still we don't have enough metrics to be there in order to evaluate the project. So the investors can easily get big percentages of tokens or equity with a small investment, but taking the risk. But on the other hand, later stage projects usually are closer to their their maximum market potential, and obviously entering those projects, maybe sometimes, okay, you're entering a brilliant project that already has lots of big names on the investment list and a really great cap table. But at the end, I mean, you have to know that, okay, if everyone has invested before you, then obviously you have missed that low valuation and you're entering in higher valuation. So this is a big trade-off. You have to decide whether you want to take the risk, or you would prefer to enter in later stages but have a safer investment. But there are, as I mentioned, there are ways to kind of eliminate the risks that are associated with early stage investments, including having additional support. That's why if you see many venture studios or smaller VCs that are focusing on early stage projects, have in-house incubators, or they work with other incubators and supportive programs, because they want to make sure that the project gets enough support. As I mentioned, money is never enough for the success of a project, especially when it's early stage. So there should be other types of support provided for the project in order to be able to reach to the potential that it has. But most of the cases, the project starts with a really low valuation, So the investors can get, like, usually those numbers that you hear, that okay, this investor made 4x, 5x, 10x on this investment, usually happens when they have entered in the low valuation. But in later stage, obviously, you can, I mean, the investors, the VCs, obviously can make some profits, especially if the product ends up being a unicorn. But still, obviously the percentage is not those huge percentages that you can see, because usually that, like, if you see the market potential and the valuation and the maximum market cap that the project can gain, it is not much higher than the valuation that the project currently has, and there is limited space for the growth of the project.
Whoa, there are some heavy insights here. And guys, listeners, I want to tell you a story. Imagine you're standing at the edge of a vast, uncharted territory, the Web3 frontier, and you see two paths. One leading through unpaved wilderness, another winding through established trails. And both paths offer the promise of treasures, but the potential for return on investment, Roy, differs greatly depending on which path you choose. And yes, early stage battery startups are like those wild unpaved paths. They represent the high risk, high reward end of the spectrum. Think of them as the pioneers of the new industry, pushing boundaries and forging their own trails. But the risks are high, and late stage Web3 startups, on the other hand, like those established trails, they represent lower risk investment with a more predictable path to profitability. And the key is to understand your risk tolerance, because uh, my is unbearable, and I'm not gonna invest anywhere. I need a specific person for it. I don't know. My creative brain cannot afford um, uh, feel FOMO more times. So yeah, if you're willing to take on higher risks for the potential of massive returns, early stage startups might be a good fit. If you prefer a more predictable path with less risks, less stage investments could be more appealing. And I want to talk more about how investors are thinking. Like, what factors should investors consider when evaluating a Web3 startup for a potential investment?
Mm-hmm. I believe each and every project is really unique and has its own story. That's why I, again, focus that in Grow Lab we are trying to not do a simple, similar standard program for all projects, because the needs of each project is different, and we have to tailor the support, and we have to customize the support and different types of services based on the needs of the project. So again, when it comes to different projects, really the factors might differ, but I can say that in all of the cases, the first factor that the investor will usually check is the team, because people, especially when it comes to the early stage projects, people do not invest in the product, because product doesn't exist there. People invest in the team, and the teams that have proven track record, have proven skills, and are trustworthy. Okay, it's not right to say that the project team should have another another successful project in their background, because that is not fair. Exactly, that is why I said we felt that there are gaps in the market. There are projects that have the potential but cannot raise funds, because having background in our market has turned into the problem of chicken and egg, because if you start your first project, everyone will be like, okay, what did you build before this? And you're like, okay, but this is my first one. If you're not willing to give me any funds because I haven't raised before, I can never raise. And once you have one successful product, then all focus and all the attention is on you if you are building your second product. This is kind of unfair, and that is exactly again what we are trying to solve, and provide additional support for projects that are doing this for the first time. But anyway, team is really important, even if they haven't raised before, but they have this vision, they have this this passion of making what they have in mind real, and they are really touching the right point in the market, meaning that they are actually solving a problem. They are creating a project that can get lots of adoption. In Web3 and crypto, everything is community. We all know that everything is community and adoption. It doesn't matter if you have the best technical quality if you don't have any adoption and you don't have any community. So first of all comes the team, and obviously the business model. Exactly what problem are they solving, how are they solving it, what is the competitive landscape, what are the competitors in the market, and what is this project offering that others are not. Usually you should have enough you should have enough reasons for the users to change what they are already using and come to a new platform, or get adapted to a new platform. And that's how you have to fit yourself in the market. If you have the right product market fit, if you have the right go to market strategy, you can reach to the right community. So after all the related factors to the business model side, which is really really crucial and important, then comes to the community, the product stage, and also the vestings. I mean, this might sound a bit irrelevant, but it is important for many investors. For example, if especially you are investing in early stage projects, then the vesting period of the project is super high. Like you have to wait for 4 or 5 years, for example. Many of investors would not prefer that, because obviously we are in the crypto market. You cannot predict 5 years. Like you can, in the best case scenario, you can predict the next 3 years. You can never predict the next 5 years. So this is too risky again, even if the project has the best fundamentals. But on the other hand, some of the projects have really suspiciously short vestings, and that is also a red flag, because this means that everyone except you can just have their tokens liquidated and dump the market. And so these factors, the tokenomics is really 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 important. Who has the tokens, what is the cap table, who is holding the power to dump or pump the token, that is important. And all these factors, from the product side to the team and the tokenomic side, the economy of the product. Sometimes we have a game and the economy is not working. The economy is sick economy that can never improve, and will always make the value of the token go lower and lower and lower. The problem that we used to have in many Web3 games previously, but fortunately now it's being kind of solved. So all of these aspects together form the final decision of the investors.
Uh-huh, uh-huh. So, listeners, did you get it? First and foremost, assess the team. Are they passionate about that three and its potential for a decentralized future? Do they have the technical expertise and industry experience to build and execute their vision? And scrutinize the technology, consider the product or service, of course, but don't overlook the community. And of course, analyze the tokenomics, how are tokens used, how are they designed to incentivize users and drive adoption? Is the token distribution fair and transparent? A well-designed tokenomic model is essential for building a sustainable and thriving ecosystem. By carefully considering these factors, you guys will be better equipped to navigate the exciting and ever-evolving world of Web3 investment. But how exactly can investors identify promising trends and technologies in the early stages of the Web3 technologies? Just look, watch the news and follow the feeds on Twitter and kind of magazines. I don't know.
That is a really good question. Like, last week I had a call with one of the VCs, and we were discussing the same question. They were telling me that we are so interested to invest in early stage projects, but we have reached to this point that we know we cannot reach to these projects. We cannot find them. So we have to invest in later stage, and that is the only choice we have. But we are more passionate about early stage. So I came to this realization that okay, this is an actual problem, because later stage projects have the community, have the sound out there, and they can reach their voice to all the investors. They can just say that okay, we are looking for our next fundraising round, series B, series A, and there is a huge community that helps them to reach the right investors. But when the project is early stage, nobody is there, and it's just a team, and they are really they are alone there. Reaching to the investors is so difficult for themselves, and for the investor to reach to the right teams and right projects is really difficult as well. So how should they reach? I think one of the best ways is using initiatives or different types of challenges. For example, you see in many of these big events, big crypto events that all of us usually participate in, there are hackathons, and there are different sorts of competitions between the builders, and even like grant programs of different chains that usually take the project through an initial due diligence and an initial screening, because obviously you want to get early stage projects, but you also don't want to take childish proposals. There should be some initial screening, some initial due diligence on the project before the investor actually invests in them. So that is where companies like us can come handy with the access we have to stage projects that we support, we incubate, and we make sure that the team will deliver. We make sure that the support is there for the project, the community is there, the partners are there, and there is this big network of us and advisors to help the project. So we usually take these projects from the chains directly, and the chains are the ones who are usually in contact with these early stage projects, because these projects first of all need help from their chain, need support, technical support from their chain. So through the chains we get access to these early stage projects, but then we do an initial screening, we do the due diligence, we pick the projects that have the high potential, we bring them in our incubator and provide permanent support for them and different types of help for their fundraising. And that is where exactly these middleman companies are standing to help the investor reach to these early stage projects, because obviously you cannot find your feed on Twitter, because if they were that if they were that well known to pop up on your Twitter feed, probably they wouldn't be called early stage. And yeah, that's, I think, using these sort of initiatives, including hackathons, different sorts of grant programs, incubation programs, especially the ones that are supported by different chains, can be a good way for reaching to the right builders, the ones that are actually here to build, not only just reaching out to you to just get some money and then you can never find them again.
Yeah, this is a serious concerns, and I know what you're saying, and it is very important to build the trust, guys. If you are wanna be a real, I don't know, game changers, then be sincere and try to give value to the community, a real one. And actually, I have a lot of questions on my mind on this topic, so maybe we can do the second episode, like the part two of this liquidity lounge, early stage VEs versus late stage investing in Web3, because I am actually running late on some other events, online ones, soon. So maybe I can give you one last question. How do you look at that?
Yeah, sure, let's do it.
Okay, so Mm, how do you think what exit strategies are available um, to investors in early stage and late stage Web3 startups?
This question is really dependent on the type of investment that the investor is doing. Like the investors have many different options how to invest in the project. Sometimes they invest through equity and through safe contracts, or sometimes they do it through soft contracts, which means the future tokens, and sometimes say there are many different legal models of the control and the ownership of the investor inside the project. Sometimes even the investor prefers to just buy liquid tokens from the market, from the OTC market. So that is really different. Based on the liquidity and based on the type of ownership that the investor has towards the project, there are different exit strategies. Obviously, if the project is giving away tokens, they would have vesting plans, and they don't want the investor to just exit the project as soon as they can. Obviously, that is a big red flag, and usually the tokens are unlocked. I mean, gradually during the vesting plan. But obviously, there are OTC deals. There are different strategies for selling. For exiting the shares, the contracts, and different strategies for um, liquidating your ownership before this liquidation inside the market itself. But those are not what we want to talk about, and those are like the not the majority of the market, and obviously sometimes not the best way to do it. So usually the best way is that the VC or the investor really communicates with the project, and because like usually a big part of the project might be in the hand of the investor or VC. So it's really important how to liquidate and how to exit to not affect the project in a negative way, to not really hurt the project, damage the project. That is really important. But obviously, the best way there is that to follow the vesting plan, and not obviously suddenly, but gradually, slowly selling small parts of your tokens in a way that it doesn't damage the market. It depends on the organic buying pressure of that market. Obviously, if the buying pressure is not there, selling means dumping the token. So it's really important to see how the market is reacting, to see the pressure in the market, whether it's the selling pressure or buying pressure, and then adjusting the exit based on that pressure in the market in a way that we do not damage the project and we do not hurt the price action of the project.
Got it. Got it. I think that my all questions today, like, oh, there are different directions of this matter, and it is kind of we can host a separate episode for each question that I ask. But still, yeah. As for the exit strategies for early stage Web3 startups, exits are often a longer game, and the goal is to build value over time. And acquisition is a common exit strategy for early stage startups, especially in the Web3 space where innovation and disruptions are priced. And a larger company might acquire the startup for its technology, talent, or community. And as for late stage Web3 startups, they have more mature exit points. They've already built value and have a proven track record, making them attractive targets for strategic acquisitions, IPOs, or secondary market sales. And the choice of exit strategy depends on a multitude of factors, and including the stage of the startup, the market conditions, and the investor's goals. Understanding these options and their potential outcomes is crucial, guys, for navigating the complexities of the Web3 investment landscape. Of course, I don't want to leave it like that, and I really want to promise to listeners a second episode. Azel, how do you think about it?
Yeah, sure, let's do it. More interact we have with the community, we're happier. Please, if you have any questions, you can always mention it in the comments of the post. I guess we'll have a post after the space, and we'll try to cover those questions as well. And thank you, Polly, again for having me.
Thank you so much for joining this episode. It was lit. And as we wrap up this episode of the Liquidity Lounge, it's clear that the Web3 landscape is a dynamic and constantly evolving space, offering both significant opportunities and inherent risks for investors. But from understanding these risks of investing in nascent projects to recognizing the potential for substantial returns, we've shed light on the multifaceted world of that three investing with Azel from Blocklogica, and we will do more for you guys. Remember, navigating this space requires a keen eye for emerging trends, a thorough understanding of the technology, and a well calculated risk appetite. And we encourage you to explore further, engage with the community, and invest wisely if you do. Don't forget to join us for the next episode of the Liquidity Lounge, where we will continue to uncover the latest developments in the decentralized world. And don't forget, drop a follow on all people on the panel. And yeah, guys, until then, stay informed, stay curious, stay liquid. One more time, huge thank you, Azel, for your participation and sincere insights. So, yeah,
My pleasure. Thank you for having me.
thank you guys. And until next time, bye bye.
Bye.